Let's get right to it. The question on everyone's mind right now, are we on the verge of a major stock market crash? Or is this just another bump in the road? With headlines swirling and uncertainty in the air, it's more important than ever to understand what's really happening beneath the surface. Is a major stock market crash looming? Investors everywhere are glued to their screens, watching every tick, every headline, and every rumor. The anxiety is palpable, and the stakes feel higher than ever. The S&P 500 has been on a spectacular run, breaking records and making millionaires. But now, it's stumbling, and nerves are fraying as volatility returns. The market's mood has shifted from euphoria to caution almost overnight. When markets soar for this long, you have to ask, what could go wrong? History tells us that bull markets don't last forever, and corrections are a natural part of the cycle. But what's different this time? The real threat? Persistently high interest rates. The Federal Reserve has made it clear. Fighting inflation is the top priority, even if it means keeping rates higher for longer than anyone expected. The Federal Reserve's fight against inflation means borrowing is pricier for everyone, especially for high-flying tech stocks. Companies that once relied on cheap money to fuel their growth are now facing a much tougher environment. Companies that thrived on cheap money now face a harsh new reality. Investors want profits, not just promises. The days of rewarding growth at any cost are fading, and fundamentals matter more than ever. The era of free money is over. Central banks are pulling back, and the safety net that propped up markets for years is disappearing. This shift is sending shockwaves through every corner of the financial world. Speculative tech darlings could be the first to fall if rates stay high. Many of these companies have never turned a profit, and now investors are demanding real results. The pressure is on, and not everyone will survive. We're at a turning point. The easy money era is behind us, and the rules of the game are changing fast. Investors need to adapt or risk being left behind. The easy gains are gone, and the market's wall of worry is getting steeper. Every decision feels more consequential, and the margin for error is shrinking. This isn't the time for blind optimism. Hope is not a strategy, and wishful thinking won't protect your portfolio from real risks. It's time to do your homework. Dig into the details, understand what you own, and be honest about the risks you're taking. Know what you own and why you own it. Every investment should have a clear purpose in your portfolio, and now is the time to reassess your strategy. The question isn't just about a crash, it's about adapting to a fundamentally different market. The game has changed, and so must your approach. Your strategy needs to change too. Flexibility, discipline, and a willingness to learn will be your greatest assets in this new environment. Discipline will separate the winners from the losers. Those who stick to their plan, stay informed, and keep their emotions in check will come out ahead. The future is uncertain, but one thing is clear. The market is entering a new era. Are you ready for what's next? The Federal Reserve's every move is under a microscope, and every word from its officials is dissected by investors, economists, and analysts alike. In today's market, every word is moving markets. The anticipation and reaction to Fed statements can send shockwaves through Wall Street in seconds. This week, their message was clear. The fight against inflation isn't over. The Fed signaled that it's not ready to declare victory, and that means more uncertainty ahead. The economy's still running hot, with strong consumer spending and robust business activity. The Fed isn't ready to cut rates, and that's keeping everyone on edge. That higher-for-longer stance is spooking investors, especially in tech. The days of easy money and soaring valuations seem to be on pause. Inflation is down from its peak, but services remain stubbornly expensive. Everyday costs like dining out, travel, and healthcare are still pinching wallets. The job market is strong, good for workers, but it keeps prices high. With unemployment low and wages rising, businesses are passing those costs on to consumers. Rising oil prices add to the Fed's caution. Higher energy costs ripple through the economy, making everything from transportation to groceries more expensive. The result? Investors are dumping riskier assets, and tech stocks are feeling the pain. Volatility is back, and portfolios are being reshuffled. The dream of quick rate cuts is fading. Hopes for a rapid return to lower borrowing costs are being dashed by persistent inflation and global uncertainty. The market must adjust to a high-rate reality. Investors are rethinking strategies, searching for stability in a more challenging environment. For investors, the easy mode is over. You can't just buy any tech stock and expect it to soar. Now, careful research and smart risk management are essential. The Fed's shadow looms over every investment decision. Its policies shape the landscape, and ignoring them is no longer an option. The days of ignoring the Fed are gone. Every investor, big or small, is watching and waiting for the next signal. Adapt or get left behind. In this new era, staying informed and agile is the only way to keep up with the ever-changing market tides. Let's check the numbers, because in the world of markets, the numbers always tell the real story, cutting through the noise and speculation. The tape doesn't lie, and today it's painting a picture of caution and volatility across the board. The Dow dropped around 350 points, a clear sign that anxiety is spreading beyond just the tech sector. This isn't a blip. It's a signal that even the most established companies are feeling the pressure. When blue chips start to wobble, it's a warning that big institutional money is getting cautious and that can ripple through the entire market. The Nasdaq, home to the world's most innovative tech giants, fell nearly 2% in just a couple of sessions. That's a sharp move, and it's making investors rethink their appetite for risk. Tech stocks are especially sensitive to interest rate fears, and right now, any hint of higher rates is punishing optimism and growth expectations. The S&P 500, often seen as the market's benchmark, slipped about 1.2%. That may not sound huge, but when the broad market weakens, it's a sign that uncertainty is everywhere. This isn't just about one sector or a handful of stocks. It's a broad-based sell-off touching nearly every corner of the market. When the S&P 500 rolls over and starts trending down, it's a moment to pay close attention, because it often signals a shift in market sentiment. Investors are moving away from risk, shifting their money into safer assets, or sometimes just holding cash, waiting for clarity. The momentum that once fueled bullish rallies has now turned cautious, with more traders looking to protect gains rather than chase new highs. Technical analysts are spotting lower highs and lower lows on the charts, a classic warning sign that the trend may be turning bearish. Don't panic, but stay alert. The market is telling a story of growing uncertainty, and it pays to listen closely. Before making your next move, take a moment to listen to the tape, study the numbers, and understand what the market is really saying. The numbers are speaking. Are you listening or just watching? All eyes are on Nvidia, the king of the AI revolution. Its stock has soared, but now it faces a critical earnings test. Wall Street expects explosive growth, especially in data centers. Anything less than a spectacular beat could trigger a tech sell-off. The stock is priced for perfection. There's no room for error. Geopolitical risks add pressure. U.S. export restrictions to China threaten a key market. Investors want answers about China and new chip sales. Nvidia's report isn't just about one company. It's a referendum on the entire AI narrative. Deliver, and the rally could reignite. Disappoint, and the fallout could be huge. The stakes couldn't be higher. This earnings call will set the tone for the market. Get ready for fireworks. Now let's talk Tesla. While Nvidia leads in AI hardware, Tesla is betting big on real-world AI, robotaxis, self-driving, and robotics. But the company faces real-world headwinds, slowing EV demand, especially in China, and fierce competition from local rivals. Price cuts and rising inventory signal trouble. The AI dream is exciting, but Tesla still needs to sell cars today. Investors are torn bet on the future or worry about the present. The stock is volatile, swinging between AI hype and auto market fears. Tesla's challenge prove it can stay profitable in cars while advancing its AI ambitions. Any sign of weakness in EVs could overshadow even the flashiest tech. The market wants proof, not just promises. The pressure is on. When markets get rough, listen to Wall Street's heavyweights. Goldman Sachs remains bullish on AI, calling it a fundamental shift, like the internet. They highlight Nvidia and Broadcom as core AI picks. AI spending is just getting started, they say, and will transform every industry. This optimism has supported mega-cap tech stocks, even as rates rise. But even the bulls warn, if the Fed stays hawkish, a tech sell-off could hit fast. Many investors are sitting on big gains. Profit-taking could trigger a sharp correction. The message long-term: AI is powerful. Short-term, expect volatility. Be optimistic about the future, but brace for bumps ahead. Don't get complacent after this market's run. Stay alert and manage your risk. So, what's next? We're at a fork in the road. If inflation cools and the Fed softens, the market could soar again. But if Nvidia or Tesla disappoint, or if the Fed stays tough, a deeper tech sell-off could follow. A 10% Nasdaq correction is possible, and painful. But is a correction a disaster or a buying opportunity? If you believe in AI and digital transformation, a panic could be your chance to buy great companies at a discount. Panics create bargains. Have your shopping list ready. Successful investing means planning for all scenarios. We can't predict the Fed or the market's next move, but we can prepare, mentally and financially. Will you see a correction as a threat or a golden ticket? Your answer shapes your future. We've laid out the worries, the Fed's stance, the drama around Nvidia and Tesla, and Wall Street's outlook. Now it's your move, buy, sell, or hold. If you're buying, you see weakness as opportunity and believe in the long-term story. If you're selling, you're locking in gains and managing risk. There's no shame in taking profits. Or maybe you hold, trusting your research and riding out the storm. Each path takes discipline, whether it's boldness, caution, or patience. The market tests us all. What matters is having a plan and sticking to it. Don't let headlines dictate your moves. Buy, sell, or hold. The choice is yours. Make it count. Booyah!